All right, what is up, everybody, and welcome back to Financial Trivia Week 14 with myself and Ryan. We are back here again with some amazing participants here for Financial Trivia. Ryan, how you doing on the Saturday evening?
Doing well. Happy for another week of trivia.
Another week of trivia.
Saturday.
Yeah, absolutely. You guys know the rules. You got 20 questions, 20 seconds for every single question, so you cannot chat GPT or AI your way through any of this here. It's all about the knowledge or if you can guess to the best of your abilities. And if you want to take part in these, we will be doing it live on YouTube next week, which would be the 17th. So put on your calendars, all that kind of good stuff. We also give away some fun stuff on those live streams as well. So feel free to mark it on the calendar. And if you want to take part in these every single week, we also put them on every single weekend in the Kingdom Discord. And I believe, Ryan, you still give out a free week on WAP, I believe?
That is correct, yes.
So if you ever want to take part in that, you're more than happy to do so, and then we can kind of go from there. So we've got 7 amazing participants here listening in on this fine evening here. We'll get it going. 20 seconds, 20 questions, 20 seconds for each one here. Here's the first question coming into play for Financial Trivia Week 14. Everybody, good luck to you. Coming in with the first question of the game. Which is not a benefit of trading options on futures over just buying or selling futures?
Yes, so trading options on a contract, so let's just say it's ES. So instead of just buying or selling ES contracts, you're trading options on ES.
Yes, and as you can see, that I'll have to kind of keep scrolling up and down a little bit, but that's all right. We'll scroll up and down and make sure we get Ryan's beautiful face on there. Oh, we lost some people, did we? Did we lose some people?
Okay, well, not everyone maybe didn't get it in time. But yes, so which is not a benefit of trading options on futures. The wording is confusing. I thought it might be. I was trying my best on this one, but you technically could not benefit from or be hurt by theta decay if you're not trading options. So that's the benefit that you get while buying or selling at just a futures contract is there's no theta decay. You can benefit from sideways movement when selling options on futures because you could structure your trade to be neutral. And so it doesn't matter if it goes up or down a little bit. If it stays within your range, you're going to profit. It can use less buying power depending on how you structure the option trade, but also depends on your broker for how much buying power is reserved when you buy or sell options. And then more flexibility to express directional assumption because you can do a strategy. You could do a put credit spread if you're bullish. And then that helps where you also benefit from sideways movement as long as your short is not tested. So.
All right, absolutely love that. You're going to love to see this part of the video because I was playing around with the window a little bit because I just keep playing around with it a little bit. But, yeah, I mean, honestly, I don't really trade a lot of futures, honestly. So trading futures is honestly not my specialty. So, that's a you question for sure, I would say.
Yes. That double negative between Q and A twisted my mind. Yeah, so it was a confusing question. So I'm trying my best here. I'm running out of ideas. So
yeah, we're gonna be running through some questions and reusing some questions over time here. So quickly, before we get into the rest of this video, just wanted to do a quick member shout out to all the people who are already part of the Fridge Financials tiers. Again, if you didn't already know, we have the 2 tiers. Open the fridge door. Tyler Johnson, shout out to you, my friend. Absolutely love your support, and I appreciate you so much. And we also have the walk-in freezer one as well. We have ICO, Ryan LP, Ticker Tap, Corey Lotsky 902, JP Silvashai, Marco Antonio Palucci. If I got the name wrong, I apologize, but shout out to all of you guys for being a huge part of the channel. You will not regret this. We have a lot of things coming up for Fridge Financials. What you can already see is there are already membership badges that you will see here. We also have emojis that are going to be there for you as well for live streams and stuff like that. And if you're wondering, Fridge, how do I take part in these memberships? It's actually really easy. You go to the Fridge Financials channel, you go to join, and you're able to pick either the Open the Fridge Door, $3 per month, or the walk-in freezer, which gives you everything else, plus members-only live streams and member-only videos. So feel free, if you'd like to support the channel still, you're more than happy to do so, but let's get right back into the video. Some questions, and reusing some questions over time here. And again, look at that, Frankie, number 1 on the board. That's absolutely awesome.
There we go.
So again, even if you missed the first question, if you ran out of time, if your game lagged out, whatever the case is, we still have 19 more questions to go, so don't worry. But hopefully you are geared up and ready to go for question number 2. Okay, question number 2 will be coming up for us in just a second here. So that way you guys are all set and hopefully all good to go. Question number 2. The CBOE recently opened a Magnificent 10 index. What is the ticker symbol for this new product? Ryan, I did not even know this.
Yeah, they just came out with it within the last month, I think. It's not on every exchange yet, but yeah. So, yeah, it's going to have to be a guess. I figured no one would really know this one, and I honestly wouldn't know if I didn't hear about it. But it's MGTN. It's going to come out cash settled index. So it's like SPX or XSP, NDX. What RUT is the Russell. So it's cash settled. It's going to be the Mag 7, and then I think it's like 3 more. I can't remember the other 3. It's like Avgo. I have to look it up, but there's 2 other companies included to make it Magnificent 10. I believe Avgo is one of them, but I could be wrong.
And if you want, I can stall for time if you want to look it up, if you really want to or not. It's up to you.
I'll look real quick.
But I've never heard of this in my life, honestly. So that's really interesting. I wonder what the expense ratio is going to be for if you do if they have ETFs for it and stuff like that. I'll be curious to see how that would work for sure.
Yeah. No, I agree with you.
He said you should name it. Yeah, what do you want to name it, Tyler? What should we name this? What should we name the Mag 10 here? What do you think? I would love to know what your perspective is of the name. Mag T or M10 are better. Yeah, I can see that. We should get one day.
You know,
we need to get the financial
I tried my
trivia
best
index
to come up with some good misdemeanors.
Gotta get
confusing ones.
Gotta get the financial trivia index coming in next. For myself and you, we'll pick our stocks.
Can I get the? Yeah, I can't. We just. I'll look for it. We can go to the next one. I'll keep looking.
All right, let's run it. Let's go to the next one here. Again, we got plenty of time here to go. So we are looking at question number 3. Right now, Frankie's in first place, still a Cabbage in second place, and there's still plenty of time for people to get on the board. Question number 3, which did not lend to the cause of the 2008 financial crisis, one of the craziest market reactions that I have seen since I've been alive. Is it loose lending practices, home prices went up, cheap credit, or rise in mortgage defaults? And that is correct. Ryan, take it away if you want to.
Yes. So, yeah, home prices went down, which is what led to everyone defaulting on their mortgages. So, basically, there was looser lending practices, and that led to a lot of people who probably couldn't afford to buy a home at X amount were buying homes at X amount. Credit was cheap, and then therefore prices started to drop in the housing market, and people defaulted on their mortgages. So home prices did not go up.
All right, absolutely love that. And StratCap put the index in there with the Mag 7. Yes. It has AMD, Broadcom, and Palantir, which makes sense.
Thank you very much.
I guess it makes sense.
I was gonna say AMD, but I was like, I don't know if that's right. And then it makes sense though that it would be those 3. Those are yes, big names.
Do you know what's crazy? Also, Jim Cramer said there's a new index that or a new abbreviation. I forgot what it's called, but it's instead of the Mag 7, it's something else where it's Coinbase, Robinhood, and something else. I forgot what it might have been. It's a weird thing that he focuses on. Let me see if I can find the.
I don't know why he'd focus on those 2. That's kind of interesting, but
yeah, it's let me see it. I want to see if I can find it. I bet I can find it. Oh, it's called PARC. PARC. Palantir, AppLovin, Robinhood, Coinbase.
Okay.
And then someone goes, you should call it CRAP, CRAP, instead of PARC, PARC. Call it.
Nice.
Yeah, so that was Jim Cramer talking about AppLovin, Palantir. Coinbase was interesting, though. I feel I don't know, Jim Cramer, I feel like Coinbase is an interesting one for him, but that's just me.
I agree. And Robinhood's pretty crypto exposed also.
Yeah, right.
So it's kind of interesting.
Right. So again, scoreboard, looking up 3 questions in. Still Cabbage in first place, and into second, backward into third, Zach fourth, Frankie into fifth. Still plenty of time to go here. Let's keep the ball rolling here. Coming in with question number 4. Futures and options on futures use a standardized portfolio analysis of risk for margin. What is this called? I do not know.
Yes. Yeah, well, I don't want to say too much without giving the answer away. So,
well, you have a lot.
Right, and that is okay.
You have a lot to talk about here. It looks like.
Yeah. So it's called span margin, which is actually standardized portfolio analysis span. T margin's just kind of regular margin. It's what you'd have like on Robinhood or I don't know, maybe IBKR, but I could be wrong. Portfolio margin's slightly different than T margin, where your requirement's lower, and that's only for a certain portfolio value. Futures margin does not exist, but span margin on futures. So you get actually you could do, let's just use an example. You could do a strangle on MES, so a short call, short put, and compare it with a strangle on SPY, and you're going to have less buying power required to set aside because of it's a futures product for the MES. And that's because of span margin.
Wow. Yep. Again, dude, I think every question's been yours so far. So, I mean, it
has all been me.
So that's what I shuffled them. So I don't know, man. That means I'm going to have to do a lot of talking later on in this episode here, which is totally fine. What are the odds of that, though? But, hey, clearly we all learned something new today because everybody got it wrong, myself included. I would have no idea what this even is. So,
well,
I appreciate it.
Not a lot of brokers allow you to trade options on futures, so that already limits, most people aren't going to know because you're not really able to do it in a lot of brokers.
Right. So scoreboard isn't going to move because no one got it right, which is awesome. So it's still everybody's game here. So if you didn't know it, no big deal. Moving on to question number 5. Which ratio best evaluates valuation relative to growth? Finally, a Fridge Financials question.
Yes, there we go.
So which of these ratios best evaluates valuation relative to growth? We talked about this. I want to say I did a previous question about this, but maybe worded differently in this case. And the correct answer is the PEG ratio. A weird ratio name in and of itself, I'll be honest. But your PEG ratio, what it focuses on is it's your price over earnings around growth. So it's PE ratio divided by the growth. Usually with your PEG ratio, again, a lot of stocks are evaluated from their price to earnings ratio in that case, but now the PEG focuses around the growth as well. And the idea behind it is that if you have a PEG under 1, usually that means that you have a very, potential undervalued play. If your PEG is super high, for example, that means it might be potentially overvalued. So, for example, I think Tesla is at like a 4 PEG or something like that. I don't know what it is at now recently, but Palantir probably has a very high PEG as well. But it's based around the earnings, the price to earnings, also around growth as well. So it's basically your PE ratio, like this one is right here, just with growth factored into it as well. Return on equity has nothing to do with growth, or is not really a good evaluation of tool for growth. And then EBITDA, or DA margin, is earnings before interest, taxes. Forgot what the DA stands for, Ryan.
Depreciation and amortization.
Yep, thank you so much. I knew you knew the answer to that one. That's why I asked you to do it. I always focus on the other ones that are more important. And I'm like, depreciation and whatever the other one is. It doesn't even matter. I didn't say to me.
Amortization.
Yeah. Sounds like you're sneezing, but yeah, sounds great. But, if you ever want to look at it, I think Yahoo Finance does a lot of things with, you can actually look at the PEG ratios for companies and determine, again, it's not the end-all, be-all for evaluating tools, but it definitely could be helpful if it's a really high growth company play with that could be very, very much undervalued. So it is called the PEG ratio. Very, very something that's interesting to note. All right, so we got Still Cabbage in first place, Track Cat second, Ann is in third, Backward in fourth, and Zach is in fifth. Moving on to question number 6. Assuming you're not cash secured, what happens to your buying power when volatility expands? Does it decrease? What is buying power? It increases or it stays static?
And when I'm saying cash secured, I'm meaning for short puts, obviously. You can't do short calls cash secured, but that is what I'm meaning.
Love that. Go ahead, Ryan. Take it away.
So actually, it increases. It is the right answer. So what actually happens is as volatility increases, so let's say you have $1,000 in buying power required for Tesla. If you had it open before earnings was announced and you're in the cycle of earnings and volatility expands in that time frame, your buying power is going to go from, whatever, 1,000 to 1,500 or 2,000, whatever number. And so you actually have to require to hold more buying power for that position. So that's why it's important to, really be paying attention to volatility in the general market and then earnings and all of that when you're creating positions, because you want to be aware of your volatility your capital required could actually go up on that position, and you don't want to be overextended in that way.
All right. Absolutely love that. David, you are not late at all, my friend. We are only, I think, 6 questions in right now, so you can still make a comeback, believe it or not. So that's very much important. Go ahead, Ryan.
One more thing to add is for the stay static. So let's say you're in a Robinhood and you only have short puts and they're all cash secured. Well, if volatility expands, it's actually your buying power is going to stay the same because they require cash secured for your short puts. So that's why stay static's not right there. Anyways.
Okay. And do you want to say why buying power is not correct?
Yeah. Well, buying power. So buying power is just if you're on margin, your buying power is your margin plus cash, minus whatever's set aside already. And then if you're in a cash account, your buying power is just whatever's like cash, basically that's unsettled, that is settled. So that's your buying power. To answer that, I didn't realize someone put that. So there we go.
Hey, man, I just, hey, if you don't know what it is, it's like, what's buying power? Who knows really, right?
What if it was a trick question? What if I just threw that in there for fun? You never know.
Yeah, right. We could just be, just that guy, So StratCat got some points up there, which is absolutely awesome. Has StratCat won this yet, Ryan? I'm trying to remember now.
StratCat has won once for sure. I don't know if he has won twice. I can't remember.
Okay, StratCat's going to let us know in the chat right now for it. Don't worry. Just once. Okay, just once. Could be number 2. He's gaining some traction here. Still a Cabbage, who's brand new to this, I believe, right? He's brand new, and he's already killing it at the top of the leaderboard still, so that's awesome to see.
Joined the Discord 4 days ago, so new to the Discord too.
Oh, man, dude. New to Discord, might give himself just a free month out of this. How awesome is that? Can't argue those results, right?
No.
All right, moving on to who's winning it. Is it Naomi or Fornova? Well, I don't think Naomi's in here, right, Ryan?
Naomi is joined now, but she is not playing yet unless she joined in. But no, right now we got Rotten Cabbage leading, David, and then StratCat in second.
Do we want to give Naomi like a 30-second join time to give her a chance?
I don't know. Can you see who's in here if you?
No, I would have to. I think I would have to end the game possibly.
Yeah. So we'll see. She's typing.
I got busy cleaning and forgot. That's all right. Forward's at work. He says he's in last. Why would you heart that? Okay, that's not very nice. I'm in last. Someone hearted that? Who hearted that? David.
Maybe it's like a hug, It's David.
Nah, David's like, yeah, I love that. I love that you're in last place. I know what David. It's a secret. It's a secret tactic. He's playing some mental games here.
Yes.
So Naomi, do you want us to wait like 30 seconds or so, or what are you thinking here? You let us know in the chat. The one who won last week.
Seconds, or we can move on. Either one.
Reign and champ. Please go ahead.
Go ahead. Okay. All right. You're welcome. No problem.
I gotta go, broski. Hey, David.
Right,
good luck, man. David, thank you for coming in, even for a minute. Yeah, we appreciate you. Don't worry. Okay. That's that's the gif he puts on his way out.
Yes.
All right, I love that. She wanted to give someone else a chance, anyways, right? Hey, Naomi, not all heroes wear capes. That's a phrase that people say, and she's one of those heroes.
There we go.
All right, moving on to question number 7. A negative free cash flow is most acceptable when the company's in high growth expansion, debt is rising, revenue is falling, margins are shrinking. This one I feel like isn't too crazy of a question, maybe, but I don't know. Depending if people Might be able to do elimination, maybe. I don't really quite know. Yeah, okay. So, so the company's in a high growth expansion, basically having negative free cash flow. The idea behind it is that you're not burning cash in a way of like your company sucks, but it's acceptable when your company is growing so much. You're putting a lot of that money that you're making and you're putting it right back into your business, right back into research and development. So your free cash flow, you're spending a lot of that money that you get coming in from investors, from shareholders, from whatever it is that you're selling for a product, maybe, all that money comes in, it goes right back out the door. So you don't have a positive free cash flow. You're not sitting on a lot of cash, right? Those well-established companies like Apple, like Nvidia, like Google, they sit on a lot more cash than the companies that are high growth. That might be quote unquote more risky plays because they're trying to keep growing and expanding and everything else. So it's definitely something it's something to keep in mind about for sure. But, negative free cash flow, you have to look into the business about why the negative free cash flow is there. Are we having a lot of growth in this company, or are they just burning cash and they have nothing left and they just have to keep spending it for no reason? So something that's very, very much important to keep in mind about. Next, so we'll look at the leaderboard here. Still Cabbage in first place, Strat Cat in second and third, Zach fourth, Backward in fifth. There's still plenty of time, and Strat Cat's on a win streak of 3 in a row for an answer streak, we should say, of 3 in a row here. And Frankie, do not worry. We still have plenty of time in these questions, and people can get stuff wrong faster than you think. We got plenty of time.
Yes, how quick you answer the questions also plays into your score. So,
right, and some people might be getting the questions right, but maybe it just takes them longer, which is totally fine. Take as long as you need to answer the questions, of course. But yeah, speed is also factored in as well. So if you start getting some questions right, you do it really fast, then, that's what it's all about. And then he says, learning more than I did in college. And that's what's up. That's what the financial trivia is all about here. We bring the knowledge. You pay for the Discord, or you get a free week from Ryan's WAP, of course. You get a free month of the Discord, or you pay for it, and you learn all of this financial education. All of it. And you don't just get questions, you get explanations from myself and Ryan. And that's what really matters and what's more important, I feel like.
Correct.
All right, so we're going to move on to question. Next question is question number 8. Which factor most often triggers systematic financial crises? Is that how you spell crises? I've never seen it actually spelled out.
I think you're right there, but did you mean systemic or systematic?
I meant systemic. I read too fast.
Okay.
Guys, don't listen to me. Just answer the questions. Read the screen, answer the questions. Don't listen to me. Go ahead, Ryan. Take it away.
This is your question.
Oh, yeah, you're right. My bad. Sorry. I don't know. Dude, I've been so exhausted from like school and stuff, and we're back to the grind of things here. Which of the factors most often triggers a financial crisis? Okay, basically, I don't know where my mind is right now, so ignore me. But what triggers usually the most of these crises is having excess leverage. If we are over leveraged as a whole in the economy, once the markets start getting a pullback and things start dropping, margin calls come into play. People start getting margin calls left, right, and center. That's when the huge factors come into play for a financial crisis. One of the big things people are talking about right now is that I believe, are at the highest level of leverage right now in this market. So in this stock market right now, we are at the all-time highs for leveraged in the markets. And that's what people are starting to freak out, and people are starting to stay in this panic mode of possibly being like, what happens when markets have a huge pullback? We start getting margin calls, we start getting all this stuff, and then people start taking money off the table to pay off, their margin and stuff like that. And then there's panic and fear, and then it causes a recession, or it causes, just a correction even. That's what the big fear is right now. So excess leverage is the biggest thing. And again, also what we want to keep in mind about is that you don't want to be over leveraged yourself. Leverage is a good tool to have for sure, but you don't want to have too much of the leverage, because if you're over leveraged, you get a margin call, you're losing a lot of your value, you're losing money, and we don't want that. So if you want to go into margin, you want to be leveraged. It's not a bad thing to kind of have that leverage, but you have to be mindful about how you are doing it. Ryan, I don't know if you have any thoughts to that, because clearly this is my question and I answered it. But any sort of questions for me?
No, yeah, I think that was good. I was going to speak to the personal, but I have a question sort of related to this, so I don't want to go into too much detail and give away the answer to that question. So,
Okay.
but you are correct. It's important not to be leveraged too much.
Right. And you think about the idea also going back to the 2008 financial crisis, right? Everybody was getting approved for mortgages and those loans and stuff like that, and they couldn't afford those mortgages. So then when people started defaulting on those houses, they started defaulting on the mortgages. That's basically the same thing. You buying a house and getting a mortgage on a house is trying to leverage yourself and try to give yourself access to, an appreciating asset that's worth a couple $100,000. And, if you can't pay it though, you start defaulting on your loans, we start getting foreclosures. That caused that huge housing market crisis in 2008. So something very, very important to keep in mind about, again, not being over leveraged. So moving on and taking a look at the table here, we've got top 5 still. Cabbage still in first place. Dude, it's rocking it so far. Strat Cat in second. Zach's moved up into third, overtaking Ann, her husband, or her, yeah, right?
His wife.
Yeah, his wife. Dude, I'm not good with words right now. I don't know why. I'm losing my mind this week.
It's all good.
Okay. Hopefully this is your question next and not mine. I don't even know anymore what I put for questions anymore.
We'll see. I always forget after we start.
Yeah. All right, let's take a look here. All right, so moving on to the next question. Which asset class historically... Nope, this is my question. Which one historically has the lowest correlation to the U.S. equities? Corporate bonds, gold, REITs, or high-yield bonds? Lowest correlation to the U.S. equities. Which of the 4 is it? Do you know the answer to this question? And that is correct. The answer is gold, okay? And again, the main reason to think about for this case is corporate bonds would be pretty heavily, I feel like, correlated with the market because, the market is based off of corporations and stuff like that, and corporate bonds. Again, if the company does well, corporate bonds usually can be doing pretty well, and you don't have a potential of not getting paid back for them, for example. REITs focus, again, in the market itself. It is real estate, but it's real estate investment trusts, which is still traded on the public markets. Gold is a thing where a lot of people like to flock to, especially in the uncertainty of the markets. Gold, silver's had a huge run up this year, or in last couple months at least. Gold's been on a crazy tear because of the uncertainty that comes with the stock market, the economy, all that kind of stuff like that. So gold is known to have the lowest correlation to the equities. So if the equities do really, really well, gold maybe not, and vice versa. That's your correlation you're looking at there. Ryan, do you have anything else you'd like to add to this question?
No, I'm not happening lately. To the correlation is more, it's more correlated, I should say. And then I think the correlation is higher than people think. I think is like it's maybe the lowest correlated, but it's still like higher than we know or something. I can't remember. I saw a Tasty Trade study about this. How it was like it's actually a little more correlated than people think.
Interesting. I mean, yeah, I think it's probably like out of these 4, like the correlation that we could possibly have here could literally be like, it could be like 60% gold and like 80% corporate. Like it could be still like a pretty high correlation, number overall, but just out of these 4, it's the lowest one. But yeah, 100%.
Yeah.
I definitely have seen that where it's like usually you think, if there's like low correlation, you're thinking of like if the market's up 1%, gold's down 1% or whatever, gold's down like 0.5% or whatever the case is. But our markets have been continuing to go up to all-time highs. We've been pushing all-time highs for the market, and we're also pushing all-time highs for gold. So, there is still a decent correlation value there still, but out of these 4, it would be the lowest one of the 4.
Right.
All right, love that. And again, tables are moving here. We got still a cabbage. We have Zach in 3 correct in a row, moving up into second place, and into third, Stratcat into fourth, backward in fifth. We are about halfway through the questions. Question number 10, which is not a component of GDP? Good Lord, another one of my questions. Great.
Oh, you had 4 of mine in a row in the beginning, so.
That's true. So which of these is not a component of GDP? This is a macroeconomic, question to, again, just to learn when you see, the Fed talk about GDP, numbers come out and stuff like that, and you get those data points of GDP, what it means. Definitely is important to know. And stock market gains have nothing to do with GDP. Consumer spending is a huge component of GDP, along with government spending, not as much. And then your net exports is also a big factor as well. Stock market gains have nothing to do with your gross domestic product. Again, it's kind of an idea of thinking about basically how much are we spending and for importing things, how much are we sending out as exports, like it's about the trade and stuff like that. How much money we're spending as an economy overall in the U.S., all those kind of things kind of factor into it. Also, other countries, same thing. Stock market gains have nothing to do with your GDP. So very, very good. For a lot of people got it right. Again, if not, it's a tough question. If you don't know macroeconomics and what GDP consists of, it might take you a little bit of time to learn about it. And it's a very important thing to learn about, especially when it comes to recessionary periods, maybe into the expansion of the economy. All that kind of stuff is factoring in with your GDP. So it's very, very important to know what GDP is. It's about how your economy is doing overall as a country. How good is your economy doing in terms of importing, exporting, spending? Where's all that money, going to? So it's very, very important. Didn't know if Ryan had anything else to add to that, but
nothing to add.
Yeah, it's a very good question. I think it's a really good one. And look at, wow, Ann just took over. Ann just went from third to first, just like that. Ooh. We have Ann in first, Still a Cabbage in second place, Zach in third, Strat Cat fourth, and Backwards in fifth. And Naomi's cheering on Ann from the sidelines. Love to see it.
But, we're halfway through exactly, plenty of time for everyone, and we're all pretty neck and neck here, so.
Yeah, it's close. That's like 100 points right there. And this is only 600 points. So you're looking at, the top 5 is within 1,000 points, and you can get like 800 points per question. So, that is definitely anybody's game.
Anyone's race.
Yeah.
Anyone's game. Even you, Frankie.
Oh, look at that. Another question here for me. It's great. How awesome is this, Ryan? Okay, what does a falling PMI below 50 signal?
I'm sure I'll get another one in here soon.
Yeah,
I'm going to have a run at the end.
I would love that. So is it expansion, inflation acceleration, economic contraction, or strong labor growth? So PMI is below 50 signal economic contraction, okay? It is one of those things where I started kind of reading more into it a lot last year. We had it happen. I forgot what time period it was. I want to say it was relatively recent in the last year, where you have like manufacturing PMIs as a data point that comes in. And when your manufacturing numbers come in below 50 for PMI, that means that you're looking at a contraction, which means it's slowing down, okay? And when your manufacturing is slowing down, that means your economy could be slowing down as a result of it as well, because you want to be manufacturing goods and sending them out and having things be, in the market and stuff like that. So when you have this contraction of any of these PMIs here, it could be a huge problem. It could start to signal an economic slowdown, okay, because it's contracting. Anything above 50 means expansion, okay, which means that we're doing well. The economy is starting to grow again, so having expansion versus contraction is what the PMI numbers look at. So if you were ever looking at your economic calendars and you look at the data, I always encourage you to look at the data when it comes out. Look into PMIs, look into all those different points of data, because that could be a huge signal of a growing economy or a slowing down economy. Doesn't necessarily automatically signal a recession or whatever, but it's just a thing to add into a data point, especially right now. If we have low job numbers, if we have high unemployment, if we have a lot of PMIs in contraction, that could be a stars aligning scenario of a real big problem for the economy. So it's things to kind of keep in mind about as we know. And take a look at the leaderboard. Still anybody's race here. We're looking at Anna's in first place. Still a Cabbage right behind in second. Strat Cat moved back up into third. Zach's in fourth. And Backward is fifth. And we still have a lot more questions to go. Mm-hmm. Next question. In a low volatility environment, which is not a recommended practice. Is this mine or yours?
This is me. This is me. God. Okay. Similar to one that you put out, though.
Yeah, I was going to say, this looks like a very similar question that I had as well. So, in a low volatility environment, which is not a recommended practice, what should you not do? Don't be like me and sell stocks, obviously. Like, that's what I did, and I lost money. So, anyways, Ryan, take it away.
Yeah, so the answer is use 50% or more of your buying power. And so this goes to Fridge's point about being over leveraged. So, and my other question related to as volatility expands, your buying power expands. So you want to make sure in a low volatility environment you're using like 20% of your portfolio or buying power. That way, when volatility expands, number one, you still have plenty of room when the requirements go up, and then also you have buying power available to take advantage of the high volatility when you're selling premium, because then that's the time where you're likely going to have an IV contraction quickly after the expansion, so you can take advantage of not only theta decay but that IV contraction. And so it is kind of recommended to go long on volatility, not perfect, but at that time, especially like right now where volatility is so suppressed, it's just like that's what happens is that's when we see the VIX kind of spike. So it's good to kind of have a hedge of long volatility because then you can benefit when your portfolio may overall be down. You can benefit on that trade. You can put on bearish delta trades because it's cheaper to put them on because it's low IV, and then you have a hedge for when there is a down move, you can actually have a winning trade when maybe your overall portfolio is down. And then, yeah, low volatility environment, like I said, you want to have buying power available to put on trades when we see that expansion.
Absolutely. Love to see that. And Naomi says Iron Condor. So
that's definitely one to throw on when you got an increase in volatility for sure.
Yeah, because your Iron Condor, well, I don't want to talk about it. I think there's a question about that involves around that, I think, a little bit later on. So we don't want to give too much away, I believe.
Is there?
I think so.
Can't remember.
I'm trying to remember. But we do a lot of options things here for sure. But yeah, definitely something that's very important to keep in mind about. Again, we don't have to take every single thing that we say, this is just some, thoughts and ideas and stuff like that. We're not financial advisors. Thankfully, with me recording today, Ryan, I have the thing up top that we're not financial advisors here. Well, it says I am not, but I think that means we together are not financial advisors.
Yes, we are not. We are not. Just recommended practices.
Right. And so taking a look at the leaderboard, we have Still Cabbage taking over again, back in first place. We've got Ann in second. We have Stratcat third, Zach fourth, and Backward in fifth. Again, still anybody's race here. As you will see, these questions are getting pretty tough because there's not a lot of people that are getting everything right at the same time. I think our first week we were putting like a bunch of easy questions out there, and now we're kind of bumping up the game here to make it a little more of a challenge here. So, yes. Which is great. We all learn something new every single week then, which I think is great.
Correct. And one more point I have is it's good to this is why you saying that people are over leveraged on their margin. It's not a good thing in a low volatility. It's like even more precarious in a low volatility environment that we are in. So anyways, go ahead.
Yeah, I mean, that's why people are, I think what I've seen some people advise online as not financial advisors also is to maybe use this time to start to get out of your margin positions if you have any, start to set some stop losses in place and stuff like that so you can get out, or some trailing stop orders, so that way if you're leveraged into a stock and you're making money on it, that's great, but set some take profit numbers in case you get this kind of pullback, so that way you get out of margin with you still maybe might lose some upside, but at least you protect your capital still and you don't have to deal with a margin call and stuff like that. So I've seen some people throw that idea around there, which is really interesting.
Yes.
All right, moving on to question, 13. What is the name of this candlestick pattern?
Had to throw it in there.
We do one of these once a week now. So if you're not sure, check out the candlestick patterns that Royalty put up in the Kingdom Discord.
Yes.
Right?
I can't explain this well, but I know what the answer is, but I can't explain it.
All right, go ahead. Well, do your best.
So yeah, the answer is dark cloud cover. 3 black crows, no one got right. That's the one I know is 3 red candles in a row. But gravestone doji, I believe at the very top there would be kind of an empty candle, like a no body, and then an evening star. I can't remember, but
that's all right.
Yeah, just threw it in there.
Yeah.
Need help sometimes.
Right. Wow, Ann got it right. Look at that. And Ann just closed the gap as the
Jeez.
only one who got it right. That is absolutely awesome. Good job, Ann. Moving on
And,
to our next question. Question 14. In a discounted cash flow model, increasing the discount rate will increase valuation, have no effect, increase terminal value, or decrease the valuation. This is my question. I know this one for a fact.
that's good, because I don't.
And believe it or not, this is actually a decrease in valuation. Why is it a decrease in valuation? The discount rate is factoring in, how much of the growth is into the actual stock itself. And so when you increase the discount rate, you're basically saying like, hey, I want to make sure I protect myself because of how volatile the stock might be in a growth environment. So for example, a company like Palantir would have a higher discount rate as opposed to a company like Procter & Gamble. One of them is much more of a valuation play and is a lot less of a risk because they're, one of those stable companies over the years, whereas the Palantir one is more of a growth play, has a lot more of a risk to it, so you have to have a higher discount rate. So the higher the discount rate means that you're actually decreasing the valuation because you're trying to factor in the risk of that company as a very high growth potential. I do that in my discounted cash flow evaluation model that I have on my spreadsheet. So again, those bigger companies, those bigger growth, those higher risk plays have a much higher discount rate to factor in to the true valuation of the company. So higher the rate for discount rate, the decrease in valuation you actually get because there's more risk. So you have to discount it more with there being more risk. If that makes sense, Ryan, I don't know if that makes sense to you or not. I don't know if I explained that well to anybody, but hopefully that kind of.
I think it made sense. I think so. I mean, we can get other feedback, but I'm pretty sure it did.
Yeah, basically, I think the best way I think I worded it way too badly at the beginning. Basically, increasing discount rate is a factoring in the risk that goes with it. So the higher the risk of the company has, the more you got to discount it as a discounted cash flow model. Basically, higher the risk, higher the value, the discount rate. Long story short. Hopefully.
Nice.
Tough question for sure. And so that again, that changes the leaderboards up a little bit here. People, it's anybody's game still. There's still plenty of time to go. We're looking at question 15 coming up next. Question 15, which of the following is not an ETF related to metals? And this one is your question, I believe.
Yes. Keyword being ETF. Forgot to bold the not, but keyword being ETF here.
Ooh, okay. I wonder, do I know the answer to this one?
I decided to throw it in there because I didn't know about the CPER or the PPLT. So CPER is a copper ETF.
Yeah.
GLD, as we most know, gold ETF. PPLT
Platinum?
is a platinum ETF.
Yeah.
And SIL is a little misleading. That's why I wanted to highlight ETF, is because SIL is the futures, the micro silver futures contract. But SLV would be the ETF for silver.
Right. I was going to say PPLT is either platinum or palladium. I wasn't really quite sure.
Platinum. I think palladium's PALL, but I don't know if that's an ETF or not.
Yeah, I know there's also some ETFs that actually have exposure to a little bit of gold, a little bit of silver, platinum, and palladium, like all four of them, I believe. So, which is really interesting.
Gotcha.
I know people are saying that like since silver had the run up recently, that next up is going to be platinum and palladiums is what people have been saying recently because those usually run.
Really?
Usually they say gold runs first, then silver's now running in this case, and then it's going to be platinum and palladium. For example, like my ring I have for my wedding that I'm going to be getting is out of platinum. It's a nice metal, it's very durable, but it's a lot cheaper than buying like silver or gold. So. Definitely kind of, it's like the idea because it looks really nice, looks really clean, and it's really durable material, and it's a lot of cheaper compared to silver or gold. So people are starting to flock to those kind of things.
Gotcha.
Fun fact.
Yeah, all the metals are kind of up right now. I mean, copper's going up, platinum's going up. So.
Yeah, I know. I saw copper, I think, was like at an all-time high of like $6 per gram.
It was
something.
I only know this because I currently have an iron condor on copper, and I don't know if it's per gram or not. It was $6 for a little bit. It's a little bit lower now, but yes, it was at $6 for a moment there.
Yeah, you also have a position in corn, I believe, right?
Yes, I do have a position in corn currently going.
Not the band, but the actual commodity.
Not the band. The commodity corn.
What
Boring, but hey, whatever, man.
What is your position on that? What did you open
It's
up?
an iron condor. It's just the corn futures. It's range bound. The IV's super high on it, so I decided to take advantage. It's very cheap too.
I was gonna say, was there a big move recently, and that's kind of why IV kind of spiked a little bit, or for corn?
I have no idea why volatility is spiked in that product. So, that's why I set it up. Like my max loss is like $774, very low risk on the grander scheme. So I was willing to play it. I mean, it wasn't much profit built into it either, but low IV, looking for opportunities.
Right. Love that. So I'm going to tell you the leaderboard isn't going to change. So that's awesome. Oh, wow. What a good job. Good math, guys. Like I did the math. Don't worry. I did all the numbers for you. Nobody changed. But hey, anybody's ready still? Moving on to question number 16. Question 16 is, which strategy profits from decreasing volatility? Long straddle, long call, iron condor, long put. This is my question that kind of went similar along with what you had earlier, I believe.
Yes, and you were right there. You were right with your earlier statement. So go ahead, though.
Right. So which one profits from decreasing volatility? That would be your iron condor. Your idea behind it, just like what Ryan was just talking about with his trades he has going right now with corn and his one with copper, is that when the IV is really, really high, doing those iron condors, it basically pins, you're pinning the commodity, the future between two strike prices, and you're hoping that, as time goes on, decay works for you. If you're going long as a long straddle, long means that you want there to be a movement. So if IV decreases, then you're going to be looking at values also going down in your options contracts. So as you'll see here, 3 of these are all long options, which would only do well when IV expands, and iron condor does well when the IV decreases. Okay, so it's very important to know that. Selling options when IV is high, buying options when the IV is low. That is the golden rule for options trading, I believe. So, Ryan, anything to add as the options man as well?
No, I mean, if you read it quickly, I could see why someone picked long straddle, because a short straddle would benefit from decreasing volatility. So makes sense.
Well, honestly, a lot of these, if this was a short call or a cash and carry put, it'd be the same kind of thing also you would think about, right?
True.
So, if any of these were the short options for it, absolutely. If I put long condor, which I don't know if that's actually what it comes up as, or does it pop up as, there's a long condor, right, as well?
I think technically, there's a short iron condor and a long iron condor, I think technically.
Yeah, so if it was a long iron condor, then that would be, obviously that wouldn't do well either. So the long options, you're looking for IV expansion. The short options, you're looking for IV, contraction, or for it to kind of, slow down. So definitely something to make note of if you're looking at buying or selling options here. Leaderboard hasn't changed, but the numbers are still relatively close, and in still a cabbage in the top 2 here. Zach's in 3rd, Stratcat 4th. Naomi's in 5th. Wait, did you join?
She did late.
Wow, and she
climbed to the top.
And she climbed up this leaderboard that quick. Goodness, I wish I got notified when they told me that someone joins. That'd be really cool.
Yeah, they should pop up something like so and so joined.
Yeah, right. Moving on to question number 17. A company with pricing power can best defend against what? A company with, I love when people call it this. They call it PP a lot. Pricing power is because that's what they do. That's what they call it as. Because we're super immature here, So they call it PP.
If you put just the abbreviation, I would not have known what that is. So.
Oh, yeah. So PP is pricing power, and it does defend against inflation because they have more control over the pricing of their goods, of their services, all that kind of stuff. So you guys all got it right, which is great, knowing what pricing power is. So if you ever hear somebody on Reddit, on Twitter, on whatever, talk about PP, and it's related to stocks and investing, it's your pricing power. I know, Ryan, even Ryan gets a little bit of a smile out of it when I say it. So, it's just...
Well, yeah.
So when they have more control over their pricing power of their goods, their services, they can usually do a better job of combating and defending against inflationary prices and stuff like that. So, very, very important to know. If they lose it, then it's a big problem, obviously. And everybody got it right. So everybody's moving the leaderboard here, and we still have anybody's game here. We have, 3 questions left, I believe? And it's close, top 2.
Yep.
It is quite
Right.
close. Still Cabbage is still hanging in there. I don't know if we've ever had somebody who's just joined the Discord who's been hanging up this high as Still a Cabbage, honestly.
I don't think so. Yeah, no. Most people are like Frankie, where they are not doing well and they give up pretty quick.
Yeah, but we still love Frankie. And you know what? Frankie, I know Frankie has been saying he learned a lot. And that's all that really matters, you know?
Yes. No hate on Frankie or anything. No shade, as they say.
Right, no shade at all. Question number 18. Yes. What is it called when the futures price of an asset is lower in futures expirations than its current price? As you can tell, it is a futures question, so this is going to be Ryan's question. I can't compete against Naomi. I mean, you can. You definitely can.
Hey, they're I don't know if they're married or they're in a relationship at the very least. So he knows when to throw in the towel probably.
Nah. I mean, all right, Ryan. Did you do this question, a similar question before? I believe we did, didn't we?
2 weeks ago I did when it's higher, which is contango. So if the forward curve, which is the prices for futures, is called a forward curve because in future expirations with futures, the price will be either higher or lower. And that's if it's lower, it's backwardation. If it's higher, it's contango, and it's called the forward curve. And it does exist.
Wow. I saw this question, we were sharing them, and I was like, dude, we did this like similar before, so it's back. Yes. It came back better than ever.
Had it written down for later on. It would have been last week, but I didn't want to throw it in there for YouTube.
Yeah, I mean, I know we got to figure out what we got to do for questions for YouTube. Maybe we'll use some more questions from YouTube. So if you were in the Discord and you want to leg up on YouTube next week, and whoever joins from YouTube, go back and watch every single Fridge Financials video on financial trivia, and you'll be good. And you can just study that way. Yeah. They'll all be there for you.
You can skip week 13, but otherwise, yeah.
Yeah, skip week 13, but weeks 1 through 12 and this one, go back and watch it. Also gets my watch time up, which is great, obviously. But besides that, it's like an hour for each episode. 14 hours you got to take time to. You study, all the questions, write everything down. You have a cheat sheet in front of you. You're good to go for next week.
There you go. Your study guide.
Fridge Financial Study Guide with Ryan LP from the Kingdom. Oh wow! Yes. All right, wow, that just opened it up. I think that showed that Still a Cabbage and both got that one wrong, I believe. So some people moved up.
It's not a common thing to know. If you don't trade options on futures mostly, but also trade futures.
Interesting. Yeah, I definitely don't know that one. Question number 19, which is not a benefit of a defined risk trade over an undefined risk trade. And Ryan, then you can say what you were going to say. I apologize.
I can't remember what I said exactly, but it's okay. Don't worry about it. And yes, not a benefit is the key word there.
Not a benefit of a defined risk trade over an undefined.
So, we'll compare. We'll say an iron condor would be a defined risk trade, and undefined risk trade would be a short strangle, short put, short call. Iron condor would be a short call spread and a short put spread. Anyways, when you do a defined risk trade, you are buying legs to protect yourself, so your max loss is known at entry. You usually use less buying power because of that, because if you sell, let's just say, a short put, cash secured or not, if you buy a call to cap it, you're going to use less buying power because you could use like $200 of buying power instead of thousands. Better for small accounts because of that reason. And the only disadvantage is that they are kind of harder to roll. So if you get tested on, let's say, an iron condor and it starts to go in the money, you really have not much that you can do management wise. You can maybe roll it depending on where the stock price is relative to your call or put spread. But most of the time, once you get fully in the money, you're kind of screwed and you just have to accept your max loss. So it's easier to roll a short strangle because there's only 2 legs. You can move up your put to your call and move your call down to your put. I mean, there's just more you can do with more flexibility with it. although it takes more buying power.
Could you, in an iron condor, essentially leg out to try to limit a little bit of loss also, or no?
Well, yeah. So, I mean, I don't know what I think you're describing. You're thinking of like, let's say your call side's fully breached. You're going to buy back the short call and leave the long call.
Yeah, so like I wonder, like you mean you can close both the short put and the long put, because those would be worth basically probably nothing. So then you could at least buy back to close the short call, and then because if you realize that your stock has some momentum with it, if you close out the short leg of the call at least, then at least you would have a long call to potentially still create a little bit of value still left in it maybe. But that's a lot more of an advanced like management thing you could do, I believe, right?
Yeah, that's a little more risky too, because then if it doesn't keep going up, then you get screwed. So technically, what I've heard a lot to do is, let's say you're fully in the money on the call side, is to buy back that put spread just to close it out. And then that way, if you do get the move down, you're going to hit your profit target quicker because you're not going to have that put spread working against you as the price goes down. But you could do what you're saying. It's just you better have your direction right, man.
Yeah.
Yeah,
no, I get. Yeah, that makes sense too, because you're like you were saying, your put side spread is definitely gonna be worth like basically nothing at that point. So you can just close that out, take all like the 90% profit, whatever you're probably gonna be at, and then hope that you get some sort of pullback potentially for it, and then that way the pullback will take your call spread and at least offsets your loss a little bit before to close it out anyways. So
yeah, you're much less options available, and you got to hope for that price move to get back to your out of money for you on both of them.
Yeah,
but go ahead.
And imagine easier to roll. I mean, like obviously it's hard to roll 4 legs. Like you have to roll like I don't know how easy it would be on any brokerage to roll 4 legs, because you're rolling a call side, a short call, a long call, a short put, and a long put. You're rolling all 4 at once, and then you're going to get filled on all those, which is not easy also. So I can only imagine how hard that is to roll that.
Yes. You have to either close out the existing condor and put on a new one full, or you have to roll the spreads individually, like roll the put spread, then roll the call spread. Because 4 legs, remember?
I was going to say, would it make sense to do something where it's like you don't open up the iron condor all at once, but like say you just sell a call option and then you do a separate order of buy the call option, like so you create the iron condor, but it's technically 4 separate legs, so it's easy to roll out each one. Would that be a possibility as well, or no?
It might help with the fill, but it still might be hard to continue to do it for a credit, depending on how tested you are, right?
Right, yeah, I got you on that one. Because that's what I've been doing for like my synthetic longs. Because it's weird on like Robinhood when you do a synthetic long, where it's like if you buy the call and then you sell the put at the same strike for it, if you do it at the same time for it, you can't roll it on Robinhood if they're linked together, which is weird. So like they don't let you.
What?
Like I can't. I've looked for the roll option, it won't roll. There's no roll tab.
Oh, you got it.
So what I did, for example, is I have a Sweet Green one right now where I think it's like a $5 call and a $5 put sold. And so I have it as 2 separate legs, same expiration date, same strike price, but 2 separate legs at least. So I can roll the put down if I need to, and then keep the call where it is if I want to.
You could do that. I think you could also just go into the Robinhood option chain, and then select them from there, I believe. But I can't just open up the option chain and make the trades you want. Yeah, like what Ann said, you might not have a roll button like you normally do, but you can open the chain.
I got you. Yeah.
And I use chain loosely based on the Robinhood UI. That's not really the options chain, but it's the Robinhood options chain.
Right. Yeah. Okay. Maybe I gotta try that. I mean, but honestly, to me, it just is easy. I can roll down a put if I want to, and if I want to roll down just the put and not the call. So like, say I want to roll the put down, so that way it's like if I want to use margin, I get a little bit cheaper at least for like. If I want to roll like my Sweet Green one from 5 to like 3, then it's like the call's still there, which is still a leap option. But I get if it goes down to 3 quick, I get assigned. Like it's no big deal. But
yes,
yeah, I get it. I'll try that out next week for sure. I'll take a look at that. And thank you for your shout out for that.
Yes, you're right. And Robinhood Legend, to be fair to Robinhood, Robinhood Legend does have a more normal looking options chain, if that's what you're speaking to.
Okay, and now, wow, we have Ann in first place taking over to the last question. We have Ann in first, Still Cabbage in second, Strat Cat third, Zach fourth, Naomi is in fifth place with one question left to go.
It's up for grabs, It's still a tight race here.
And I hope it's a hard question, honestly, just because it makes it more fun.
Yeah, well, let's see. We'll see.
Last question of trivia. Here we go. Which component of CPI is most volatile and often excluded from core CPI? And of course, it's my question to finish it off.
Yes. I would not know this one.
So which component of CPI is most volatile and often excluded from core CPI? Oh, wow. Everybody knew the answer. Dang, that moves the fun.
I would not.
But yeah, so energy is one of the big ones because energy fluctuates month to month. So if they're looking at inflation and seeing how inflation is trending, they remove these volatile ones so it doesn't impact the overall core inflation. That's why they call it the core PPI. So they take out, I want to say off the top of my head, I think food is also taken out, I believe. If someone can, I don't know if somebody in the chat knows or not. I believe food's taken out, but energy definitely is one of them that's taken out because, month over month, there's a big switch over for energy, like oil and stuff like that, so you never know. So they usually take it out for the core CPI. There's also a core PPI as well. So people like to look at the core PPI and the core CPI because that takes away those volatile movements as a result of it. And look at that. Ryan learned something new today. How cool is that?
I did. I mostly don't know any of your questions, to be fair. So,
and I don't know anything about the futures. So, we both learned stuff new today.
Yes.
So, in taking a look at the leaderboard, what a fun game we have played this week. In the podium, we've got in third place, Strat Cat. Congratulations, my friend. In second place, we've got Still Cabbage. And then in first place, with the most points, is Ann. Congratulations, Ann, as per usual. Rotten Cabbage, let me tell you, man, dude, you gave him a run for your first week playing here. So all credit to you. Like, that is not an easy thing to do, and you really made a run for the money here. So we would love to have you here every single week, Rotten Cabbage, because you put up quite a fight this week, I will say.
Yeah, there we go. But great job, Ann. Great job, everyone.
Yeah, absolutely.
Thanks for joining.
What were you going to say?
I said thanks for joining.
Yeah, guys, absolutely. Thank you for joining. So, again, we're going to reach out to Ann and ask if she wants, a free trade or another free month or whatever, or if she wants a Fridge Financials membership free on YouTube. We can make that happen somewhere. Whatever it is that she wants, we can definitely make it happen for us. So that is it for the YouTube portion of everything. Again, if you want to tune in and take part in these, next week on the calendar, mark it January 17th. Free entry for everybody here. If you win, you get a free month in the Discord of the Kingdom, which is an amazing offer, or other prizes as well. And I will also be giving away 5 free memberships for the month, top tier of Fridge Financials. Ryan, anything else that you would like to say before we sign off for the night?
Just 6 p.m. Eastern for that next Saturday. But yeah, the fun time. Thanks for joining. Thanks for watching.
Absolutely, man.
And congrats, Ann.
Yeah, absolutely. So, guys, hopefully you enjoyed the trivia as always. Make sure you guys tune in every single week for myself and Ryan doing these, and we will always catch you guys in another video.